Understanding business tax classifications can save you significant time and money. A disregarded entity offers unique advantages for certain business owners. But what exactly does this term mean? A disregarded entity is a business that exists as a separate legal entity from its owner, but for federal tax purposes, the IRS treats them as one and the same. This creates an interesting situation where you maintain legal separation for liability protection while enjoying simplified tax treatment. The most common example of a disregarded entity is a single-member LLC. While the LLC provides liability protection that shields your personal assets from business debts and lawsuits, the IRS disregards this separation when it comes to income taxes. This arrangement offers several benefits. As the owner of a disregarded entity, you report business income and expenses directly on your personal tax return, typically using Schedule C. This pass-through taxation means profits and losses flow directly to you, avoiding the double taxation that corporations face. You maintain the flexibility to change your tax classification in the future if your business needs evolve. However, disregarded entity status does have limitations. It's primarily available to single-member LLCs. Once you add another member, the entity automatically becomes a partnership for tax purposes. Some institutions may be confused by your tax status, and state-level tax rules don't always align with federal treatment. Additionally, owners may have restricted access to certain tax-advantaged employee benefits. The Internal Revenue Code assumes businesses are corporations by default. However, eligible entities like LLCs can elect their preferred tax classification. A single-member LLC automatically becomes a disregarded entity upon formation, unless the owner specifically elects corporate taxation. It's important to note that disregarded status only applies to income taxes. For employment and excise taxes, these entities must still use their own employer identification number rather than the owner's Social Security number. The disregarded entity remains responsible for filing and paying these taxes separately. Foreign entities can also qualify as disregarded entities for U.S. tax purposes. In such cases, the foreign business is taxed as a foreign branch of a U.S.-based company. All income is taxed as the owner's income, even if profits aren't directly distributed. Foreign-owned disregarded entities face additional compliance requirements, including filing Form 5472 annually, with substantial penalties for non-compliance. Not all business types can be disregarded entities. Sole proprietorships, while similar in tax treatment, aren't considered disregarded entities because they aren't registered as separate legal entities with the state. Multi-member LLCs, partnerships, and corporations all file their own tax returns and therefore don't qualify for disregarded status. If your business needs change, you can elect to change your tax classification by filing IRS Form 8832. This allows you to be taxed as a C corporation or, with additional paperwork, an S corporation. Business owners might make this election to retain profits for expansion, access different retirement plans, or obtain certain fringe benefits. Disregarded entity status offers a valuable combination of liability protection and tax simplicity for single-member LLCs. Understanding how this classification works helps you make informed decisions about your business structure and tax strategy. While the default classification works well for many small business owners, knowing your options allows you to adapt as your business grows and evolves.